risk parity portfolio allocation. We're going back to, well, I put a lot more pictures.
Way to spoil the party. Risk.
Wow.
I know, right?
Risks.
All right, I'll go on the internet.
We got Julia and Jacob back to back today. Way to spoil the whole holiday.
Hey, I think this is a fun one. I put a lot more pictures in this one compared to the one from last week.
Oh, good. Thank you.
Yeah, we got pictures this time. And it's also, this is a back of the envelope calculation, which I think is kind of fun. This is more for an equities portfolio. It's a little bit more nuanced when you want to apply something like this to options, because you want to keep in mind, obviously, position size, and you would want to measure risk in a different way. So this is kind of the classic one for an equities portfolio, but I still think the concept's really interesting, so I wanted to talk about it. Yeah?
Okay.
Let's do it.
Go.
Yeah.
Let's do it. Okay. So last week, we dove down this whole rabbit hole into modern portfolio theory as an approach to diversifying a portfolio. This was the kind of continuation of that whole portfolio diversification, portfolio allocation sort of series that we're talking about. And today I wanted to talk about this method, which can be used to determine portfolio weights based on the allocation of risk rather than the allocation of capital, which I think is a very interesting concept. Makes sense?
Okie dokie, sure.
Easy peasy, right? Like nothing.
Yeah.
Okay.
Yeah.
A little bit of background, okay? So portfolio allocation strategies, they typically focus on allocations of capital that are most likely to achieve a certain level of risk, a certain level of reward, a certain level of diversification. So for this kind of example, let's just talk moderate growth equities portfolio, 60-40. This is going to be kind of hybrid, 60% stocks and 40% bonds and metals. So to keep it simple, our portfolio is going to have SPY, QQQ, Apple, TLT, and gold, 20% allocated to each. Right? Yeah?
Yeah.
Moderate growth equities portfolio. Okay, so when we take these 5 elements with equal capital allocations to each, our capital allocations on this chart are represented in red, and you can see they're all even, right? When you look at the risk contributions, not exactly the same thing as volatility, risk contributions, a different calculation, but when you look at the risk contributions of each of those components from 2015 to 2022 in white, you can actually see that SPY, QQQ, and Apple have much greater risk contributions compared to TLT and GLD, which is what you would expect, right? They're much lower volatility assets. So if you're allocating kind of 20% of your capital to each, you would kind of expect that Apple would, as a more volatile asset, contribute a lot more risk to this portfolio. The total portfolio volatility is 13.7%. The risk contribution of Apple is about 5%. So a lot of that's coming from Apple, and then you got good amount coming from NASDAQ, good amount coming from SPY, and then very little coming from TLT and gold, which is, again, expected, right?
Right.
Yes.
Sure.
Right? Okay, so the idea of a risk parity portfolio is that we kind of want all of these components to sort of contribute equal amounts of risk to the portfolio overall, and to figure out what weights we would need in order to achieve that. And it really focuses on this idea of allocating risk rather than allocating capital. And so this is a risk parity portfolio. An example of that, and you can see those white bars, those risk contributions are a lot more even. This, risk parity portfolio has, a volatility of about 10% with about 2% coming from each. And you can see there's a much greater emphasis on TLT and GLD when you do this risk parity approach, and then much less allocated to Apple and the NASDAQ and SPY, right?
Yes.
Kind of makes sense.
Yeah.
So the actual process of calculating the weights for a risk parity portfolio is actually a pretty intense numerical optimization problem that I'm going to dive into more on Bad Trader because we got more time there. But there's a nice, naive back of the envelope calculation that I wanted to kind of cover. It doesn't get as close to the true risk parity as I'd like, but it gets you a little bit closer than the sort of original idea of just equal weight capital allocation. Yeah?
Mm-hmm. I'm there.
Okay. So we're going to show some math, but it's actually not as bad as it looks. We'll go through a numerical example in a second. But when we look at naive risk parity allocation, it's sometimes called inverse volatility weighting. The goal really is to give a higher weighting to lower volatility assets and vice versa. So the risk contribution is a little bit more even. It's a little roughly the same across assets, although I'll show the actual results in a second. It doesn't get as close as actual risk parity, but it's, for a back of the envelope calculation, not that bad. This is the equation. I'll show, again, a numerical breakdown in a second. But basically, to determine the weight for each asset, we want to take 1 over the volatility of the asset divided by the sum over 1 over the volatility of all the assets in the portfolio that we're looking at. For n assets in our portfolio is what this equation is kind of looking at. Does that make sense?
That's exactly how we that's the back of the envelope. I mean, I don't know the formula, but that's the back of the envelope approach we use right now. Sure.
Yeah, it's probably the back of the envelope thing that you do in your head.
Yeah.
Although I will say, for options, it'd be a little bit different because here I'll show the example.
We don't do it with options. I mean, we do it with the underlying.
Right. So yeah. So this I think has interesting applications and options, but again, this process is more for an equities portfolio because the way that you measure risk is obviously different with options, and this kind of assumes a fully allocated portfolio, whereas we want to control our position sizes when it comes to options. So there's more nuance there, but the equities scenario is a little bit more interesting. And so here, for example, we got our let's go back at our example portfolio: SPY, QQQ, Apple, TLT, and gold. 2015 to 2022, we have all of our daily returns, right, during that period. So first things first, we're going to calculate our standard deviation of daily returns of that asset. So for SPY, it's about 1.14%. Makes sense. Daily returns volatility about 1.14% historically. QQQ is 1.40, Apple 1.83, et cetera. You can also use IV here in place of historical volatility, which is actually kind of cool. So if you don't want to calculate it yourself, you can just pull it from a platform and then plug it into that formula that I showed. But first things first, we got to measure risk. So for equities, we would use kind of returns standard deviation, right? Makes sense, yeah?
Mm-hmm.
And then once we have that, we would just kind of plug those weights into that equation. So for SPY, for example, you would take 1 over the volatility for SPY, 1 over 1.14, and then divide it by the sum of 1 over all of the volatilities in the portfolio. So 1 over 1.14 plus 1 over 1.40 for the Qs plus 1 over 1.83 and so on. And then you would get about 20% as your risk parity portfolio approximation weighting for SPY. Yes?
Okay.
I'm fine.
You can use annualized volatility. You can use daily volatility. It kind of doesn't matter as long as all the volatilities are time scaled the same way. So like IV is annualized as long as you use IV for all the assets, or as long as you use daily returns volatility, as long as they're all the same, that can kind of work.
And why can't we just use notional times the volatility?
You can that works too.
Yeah. Okay.
But if you wanted to apply that to equities, we want to be inclusive around here, perhaps, for all the different types of traders. This is the equities approach. But like you said, it's actually very similar to some of the other types of, strategies that options traders use. It's just with different metrics. Yeah. So if we now take this and we repeat this for all the different assets in the portfolio, it gets us closer to risk parity. When we do this again, this back test from 2015 to 2022. Now those white bars, those risk contributions are a little bit closer to being even. And we can see that our weights, as we would expect, give much higher weighting to TLT and GLD, with about 25% allocated to each, and then closer to 12% allocated to Apple, 20% allocated to SPY, and so on. And then, those are more even risk contributions, but it's not as close as even as the actual risk parity can actually get you. But that being said, it is closer, and for a back of the envelope calculation, I think it's a pretty simple thing to do, and it's pretty easy to understand. And it does get you a little bit closer. But again, true risk parity, which you probably wouldn't implement yourself. There's online tools that can be used to kind of do this calculation. But the back of the envelope way, I think the process is interesting.
Well, it clearly looks a lot better than the equal weight. Yeah.
Yeah, right. It's a little bit better.
Yeah.
But that being said, I think one of the drawbacks of doing this is that it really doesn't take your expected returns goals into account. We're really just trying to sort of, equalize sort of risk contributions to a portfolio, and with the goal of maybe having a higher Sharpe ratio, of having more stable returns over time. But depending on your goals as an investor, expected returns are obviously something you'd want to keep in mind. So I don't use any of these diversification or weight techniques in a vacuum. You usually want to use it with a bunch of other stuff, especially, for options. Like the way you measure risk is very different, right? So this isn't quite one-to-one.
Got it. True. Okay.
Easy peasy.
Interesting. Good.
It's a fun one, right? It's a fun,
Yeah.
We're going back to form a little bit. And a lot more pictures this time. But just to conclude, risk parity portfolio allocation focuses on the allocation of risk rather than the allocation of capital, with the goal of having each asset contribute roughly the same amount of risk to the portfolio overall. And while true risk parity is a pretty complex optimization problem, there's a naive approach that can approximate these weights with a back of the envelope calculation that places more emphasis on lower volatility assets and vice versa. And next week on Bad Trader, because again, that's that's a live stream, so we can just go into these crazy dives. We're gonna go into more of the methodology behind true risk parity and talk about our covariance matrices and such. But this one was a bit of a lighter version of that, so I thought it'd be